Hello, I'm Lelda Smits for the Finance News Network, and joining me from London's Kingston University is Head of Economics, Politics and History, Dr. Steve Keen. Steve, welcome back to Sydney and to FNN.
Lovely to be here again.
2014 has just wound up. What's your assessment of the global economy's performance?
Well, it's a classic Parsons egg. Parts of it were excellent, but the parts that were excellent were quite tiny. And those basically being America and England both going through a form of revival after the global financial crisis. So I can certainly say that those two Anglo-Saxon nations are out of the global financial crisis. Whatever's going to come along will be a new experience, not a continuation of the old one. But Europe is trapped in a total quagmire. And China's growth, which has been slowing down, and of course it has to slow down because you simply can't grow at that rate indefinitely. That slowdown is also starting to worry people about what is going to be the engine of growth in the global economy. If I had to summarise use one word to describe the economy, it's fragile. And that's where the egg analogy comes in as well. What's going to crack the egg?
Now, looking closer at the US, QE is winding down, and US Federal Reserve Chair Janet Yellen has signalled interest rates may rise in 2015. What's your forecast for US interest rates this year?
I think they're going to continue seeing improvements in unemployment, which would give them a signal to put rates up. They're going to continue seeing inflation go too low. It's well below their target of 2% now and heading actually towards deflation. With that combination, they're going to sit on their hands. They might at some stage tentatively put up rates to try to control what they might see as a potentially overheating economy. But I think in general the rates are going to be on hold.
Now, Steve, closer to home, Australian interest rates remain at a record low of 2.5%. When do you expect we'll see the next move, and what's it going to be?
I could see them making a couple of cuts this year, and possibly more than that. But the unemployment rate in Australia now is the worst it's been in 10, 15 years. And the only thing keeping it up is the housing bubble, because that's pumping borrowed money into the economy. People are spending that money. And of course, also foreign buyers pumping money and buying real estate. Those are really the only two massive inflow sources into the economy. If the housing bubble pops, then that inflow also stops. And we therefore have a downturn driven by, finally, a housing bubble bursting. So those dangers are there. You can see plenty of reasons for the cash flow spigot to be turned off. I can't see many ways of turning it on anymore.
Okay, so now we're at 2.5%. Where do you see the RBA leaving interest rates by the end of this year?
Certainly of the order of 2%. Maybe I'd be surprised to see it below the 2% rate, but I wouldn't be amazed.
So, Steve, if interest rates fall this year, as you suggest they will, how will this play out for the so-called bubble in the property sector?
They could keep it going. But what it means is it's with more and more fragile on the bubble continuing indefinitely.
So what kind of catalyst will we need to see in order for this property bubble to pop?
Well, two things. Partly the economy itself slowing down so much that the negative returns in rental become excessive on those. They're having carrying costs. Now, of course, they're passing those carrying costs onto the Australian public through negative gearing, but they nonetheless have those carrying costs to handle. And also if there's anything going wrong in China. Of course, things going wrong in China can go in both directions. If you have a serious downturn in China, then it's quite possible Chinese capital could respond by trying to get offshore and do more buying overseas. So a slowdown in China, because it's a speculative slowdown, doesn't have to mean a slowdown in demand for Australian real estate.
Finally, Steve, could you paint us a picture of the global economy this year, and where may investors be surprised?
Well, the major surprise potential surprise is the euro. I mean, I've got to say one thing. Paul Krugman and I both have in common. We both got the euro wrong for political reasons rather than economic. We both have been saying it's always been an economic disaster. What's been amazing is how strong Europe's committed itself to staying in that disaster because they see it as a form of European unity. I think it's a form of European fragility. It'll cause the place to break apart at some stage. This may be the year somebody breaks out from the euro. Now, that'd be the biggest surprise in the global economy.
Steve Keen, thank you for your insights and outlook.
You're welcome.